All right, guys, thanks for joining us. Zach Twardowski here with Silvana Pahor Flores.
You got it.
Got it. Cool. So we're gonna talk a little bit different about a different topic today. Not centered towards agent training or anything like that, but about if you're someone who's making a significant amount of money, some tools you can use to help set yourself up for retirement. So whether agents are watching or just people looking to get into setting themselves up for retirement properly, I think this would be beneficial for them. And we're gonna cover IULs first. So I guess first, can you give everyone sort of a simple breakdown of what an IUL is? And how it can be used as a retirement vehicle.
Absolutely. Well, first of all, thank you for having me here today. And yeah, I really enjoy the advanced market. I like the IULs as a separate or alternative vehicle. For younger people that are scared of the stock market or volatility, or maybe they want to be their own bank to have access to cash value and avoid penalties or whatnot. So they're a really good alternative to a Roth IRA or separate kind of retirement vehicles.
Mm-hmm.
There's not only retirement. An index universal life is not only a retirement, but it can also work, when we have a significant amount of cash value to either send your kid to school or set up business expenses.
Yeah,
stuff
tax-free
like that.
retirement, kind of.
Correct.
So, before we jump into what scenarios you might use it, can you explain simply how it works, people? Because there's some of the money you pay in is going to go towards paying for life insurance, and then the excess of that's going to go towards your setting up your retirement, right? So how does that work? And because there will be some cost that goes towards life insurance too.
Correct. So an IUL is just not an investment vehicle. They're guaranteed contracts, which is pretty cool, right? So part of the contract is done through an insurance company. So we're buying life insurance first and foremost. How we set it up is the least amount of life insurance that you can get for the most accumulation allowed by the IRS not to be taxed. So it grows, the cash value grows. We're paying for life insurance forever. It's protecting the capital, the being alive, or if someone dies too soon. And the second part is it accumulates over time on a compound interest, not directly in the stock market, but through an index that is indirectly in the stock market.
Right, participates in the market.
Correct, participation. And what it guarantees in the contract is that there are no losses. So while people right now are losing 20, 30% in their portfolio, the guarantee is no loss. Zero is your hero, what it said.
Okay, so a tiny amount goes towards life insurance. The rest of it goes towards the retirement account part of it.
Accumulation, correct.
The accumulation account. And like you said, compounding interest. Someone once told me that compounding interest is the 12th wonder of the world. Or whatever.
The eighth wonder,
the eighth wonder of the world. Yeah.
Einstein.
Is compounding interest. And correct me if I'm wrong, but this is one of the only vehicles where you can have compounding interest and then not have to pay taxes on that at any point unless you cancel your contract.
Correct. So for as long as the contract is in place, so there's life insurance, it doesn't lapse. When you're taking funds out of the IUL, we call them loans. The tax code is 7702 if someone wants to look it up. So we're taking loans, so it doesn't get reported to the IRS. So it's not taxable, which is pretty awesome how much money you can accumulate there and not have to pay. It's a great tax mitigation strategy.
Right. And as you know, when I was 23, I set one up on myself, paying a couple $1,000s a month into, and so I'm just giving a brief, overview on it because I don't know the specifics on it very well, but a couple $1,000s a month into it, I think 2+ or something like that. And then by the time I'm 50, I can take out, I believe it's somewhere around $20,000 per month to live off of, and I don't have to pay the loans I'm taking out back. So can you explain to people why don't I have to pay the loans back on that?
You just don't. It's set up that way because you're taking loans. It's just reducing the cash value you have in the policy, right?
And then if I die still, and say the death benefit's $1 million or $2 million or whatever, that still does get paid out, or does that not get paid out?
The death benefit will get paid out.
Just not the cash value.
Just not the cash value.
Perfect.
Right. The death benefit would always be higher than the cash value in the account, though.
Right. And so I remember when I was listening to Sean Ruggiero and you and other people telling me to do that, the reason for doing it was Sean asked, do you think that taxes are going to be higher or lower 30 years from now? And I was like, I don't know, probably higher, right? And he's like, typically, no one knows, but it probably will be higher. So if you pay this money you pay taxes on now into this, then in 20, 30 years, you don't have to pay taxes on it again, and you don't have to pay taxes on the compounding interest, which is something that, on the growth within the account, which is something that's very rare. I don't know if there's any other way you can do that, is there?
There's no other way.
There's no other way.
And the great thing also is not only paying taxes on the accumulation, But a lot of people, young people, they're working really hard and making, in order to make a lot of money and set up themselves for success. So they will be in a higher tax bracket. So it's pretty cool to avoid X amount of the portfolio not having to pay any taxes at all.
So like on mine, and I guess I should probably know more about this. I just trusted you guys and set it up. But so when I start taking out the whatever it is, say it's 20,000 per month when I've turned 50, I think is how we structured it. So I take that out. I pay that does not affect my tax footprint at all.
At all, no.
Okay, so long as I keep the policy in force, do I have to keep paying premiums on it at that point or no?
That we customize for each client according
Okay.
to what they want to do. We can set up someone to pay for 30 years or 20 or 50 or forever, according to their goals, their fears, what they want to accomplish. So it's different.
I think
for
on
each
mine,
person.
I stopped paying at that point, and then I just so the basically the cash value pays the premium, and then I take the money out that I need to live on.
Correct, because the cash value keeps growing with the index.
Got it.
So you can leave it there, you can take it out. The other cool thing is it will not affect your Social Security taxation.
Right.
Not at 50, you're not taking Social Security, but later in life, some people get their Social Security tax 50 or 85% or 0, which could affect the yearly income significantly.
Okay, got it. And then just so for everyone understands this part, if people like the nitty gritty, the participation part. So say it's participating in the S&P or something, right? And that goes up 10%. How many gains will you get on average? Or if you had to give a ballpark, where does that usually range from? So if it goes up 10%, what do I get in mind, do you think?
According to different companies, there will be a roof of growth for the guarantees of no loss. Typically, they are 10%.
Okay. So say if it goes up 12%, I'll get 10.
10%.
If it goes up 8%, I get 8.
You get
But it
8.
caps off at 10.
Correct. If it
Okay.
goes minus 49, like
I
it
get
happened-
0.
Correct.
Okay, got it.
Yeah.
That makes sense.
The
This is good because I'm learning more about my IUL too that I pay into.
That's true.
Yeah.
The average though of the Standard & Poor within, since it started on the past 20 years as well, it has been an average of 10.5% regardless.
Okay,
So-
got it. So you get that on average, and then again, when it goes down, so say you get, whatever, 20% over a couple years, like whatever happened the last 8 years, you get really good, and then the market crashes, you just stay at the high water mark that you're at.
Correct. So you say at the last year credited interest, so you don't lose anything. You just stayed where you were. So it grows like stairs. So it goes up. That's the participation. When the market goes down, you stay flat.
Okay, and then when it goes back up, I start from where I was at, not
Correct.
from down here.
Yeah, just think about this. If you have $100,000, there is a loss of 50% in market. Now you have $50,000, right? In order for you to go back to that 100,000, you need a gains of 100%.
Yeah,
So it takes a lot of time to grow when you have a loss, just to
Right.
be at the same.
yeah, you have to grow more than the amount that you lost to get back to it. Okay, perfect. So a couple other questions I'd written down for you. We covered how it works. So when should someone consider something like this? Like what kind of demographic are you looking for? Like, is it someone who's, I know it's not a round number, but you should be able to set aside X amount per month for retirement to make something like this vehicle make sense, like kind of a minimum number.
We customize that for every person because it has to do with how much your bills are every month, how much you're bringing in, and how much you're spending, what your goals are, how old you are, if you're healthy, if you're not healthy, smoker, non-smoker. So in your case, if I'm sitting down with you, you have a long time to accumulate, right? So of course, we start there. And what is your availability? You don't want to go and just 25, 27 years old and just put $100 because you're paying for life insurance first, right? So we need to make sure what is your contribution towards your retirement. So you want to put, whatever will be a contribution to a Roth IRA or to a 401k, what it will yield, and then we take it from there. But, more than just life insurance
Right.
premium.
It's like for me, I have 401k now and they match. So there's no reason not to do the match, right? Like that makes sense.
Best money is free money.
It's free money, right? So for another interesting thing I wanted to ask you is, when should someone, or like a Roth IRA is a really good tool that does the same thing or very similar thing.
Similar things.
The only difference would be that you would get taxed on that, correct?
No, Roth. Well,
Roth,
no.
because you pay with tax
Correct.
dollars, so
The
you don't get
growth is
taxed. So it's
tax-free.
very similar in that way. You don't get taxed on that. So why would I do an IUL instead of a Roth IRA?
Well, that's pretty cool that you asked. I did a video on my Instagram that I posted just comparing them both. A few differences. I mean, they grow pretty similarly, tax free. But with a Roth, if you're making over $130,000 a year single and over, I think it's 190 or 200,000 married, you can now get a Roth.
Okay, got
right?
it.
Growth is the same, but with a Roth, if you're younger than 59 and a half, you will get penalized 10% from the get-go on top of your taxes.
So if
So
you're married and you make $200,000 as a couple, let's say, what's my option then? Is there anything
that
else
is
you
when
can
you want to
do,
go
or is
with
that
an
the only
IUL.
is an IUL the only thing you can do at that point, or are there a couple
I
other
mean, there
things?
might be a lot of other options, but if you want accumulation, safety of the accumulation, you can go into the stock market if you want to.
Right.
But if you want security and growth, right, you want to do an IUL for that fact of not losing money. You can overfund it. You don't have limits like a Roth. A Roth at your age is only $6,000 a year.
Okay,
Right.
got it. So so even if you make 200,000 as a couple, and I contribute six to or under 200,000 as a couple, and I contribute six to the Roth, I can't do any more.
No, you
Even if I'm really
cannot
good with my
do a
money and
Roth
budget
at
it.
all if
Oh,
you're
okay.
making certain money.
If I make under it though, let's say, and I contribute my 6,000, then I can't give them any more than that for the
If
Roth.
you are 50 and over, you have catch-up contributions, that is 7,000. But if you're trying to, you have extra amount of money,
Yeah.
or you
Yeah,
you
like
have,
say I make 120,000, so I'm below the amount, and I'm really good with my money, and I want to contribute 20,000 per year. Let's just say I can't do that into a Roth IRA.
you can't.
Got it. So someone may do six into the Roth and then put the rest into an IUL.
Yeah, and the other thing about the IUL, you can take money for as long as you have accumulative value, cash value in the account. You can take money out without any penalties and use it for anything.
Right. In the Roth, you do whatever penalty for that.
Yes,
Got it.
10% is a lot of money.
And okay, so it's 10% on that. Got it. And then the other thing you mentioned too that people use this for is you can use it also for kids you have to help them set up, a college account or something that you won't be penalized if they don't use it for college, right?
An IUL is pretty awesome because it's like the Swiss Army knife type thing.
Okay.
The cash value, you can set it up to fund college for a kid and avoid, the financial aid analysis. It doesn't count. You can set up for business expenses.
Okay.
Real
So like if you had a
estate.
kid that decided to be an insurance agent and didn't go to college and you had a traditional, whatever plan, 529 plan for college, they get penalized on that, but with an IUL you wouldn't. So
You
that
wouldn't.
gives you a little more flexibility.
Correct. 529, for example, you can only use for educational expenses. Otherwise, they're going to tax you and, other fees associated to that.
Okay, got it. So that way you don't feel bad if your kid decides I want to be an entrepreneur or something and I want to go to college, then you can still give them some startup money there as
Correct.
opposed to, okay, and you won't have to pay the penalty.
No, not at all.
Is that something you can transfer to your kids at some point? Once they turn 18, they're making them, or 20 or 5 or whatever, they're making their own money. Can they take that
Yeah.
contract over and start?
Since it's a life insurance contract, you just transfer ownership.
Okay.
You got to
got it.
own as a parent or grandparent. You got to own it. I cannot own your kid's life
Yeah.
insurance.
So if like we're about to have a daughter in like a couple months. So if she gets to 18, I'm like, dude, you're on your own. Like which I probably would never do. If I have a son after this, that I would do that to him. The daughter I'll probably pay forever. But in
She's
theory,
just going to be your girl
yeah.
forever.
But in theory, I could go, hey, you got to take over your life insurance contract. I'm good. Like
Yeah,
you're
you
18.
just transfer the ownership.
Okay,
So
got it.
they can control who their beneficiaries will be versus you.
Okay, perfect. Anything else you think people should know about IULs and kind of the nitty gritty on how they work?
That they want to do, number one, go to my Instagram.
Well, they want to call you
Cortez.
so you can do it for them first and foremost, right? But aside from that,
Just learn a little bit more, but always reach out to a licensed agent, an expert, to customize the person, the agent that asks the most questions to get to know the family and the fears, the goals, is the person that is going to help them the best.
Got it.
So just reach out, book an appointment. That's what it is.
and if someone's interested, they can reach out to you. You can put together like an illustration for what it would look like depending on how much they contribute and how much money they would have and whatever I did for myself. Like you can do that for anyone.
I do it with them over
Okay.
Zoom. I showed, or if I do it in person, I do it with them.
And so you can show them if you pay $500 a month, this is what it looks like. But if you pay $200, this is what it looks like. And if you pay $3,000, this is what it looks like. So they can. Okay, perfect.
That's pretty awesome.
Awesome. Well, thank you so much for sharing. And
Absolutely.
I got to learn more about my IUL today too. So I appreciate it.